Conversation there, the overall dichotomy that we are seeing in terms of the growth rates versus what the market is saying. But for now, the market is consolidating a bit very sideways. So Nifty continues to be in the red at the moment, down about 70 points. But Mr. Guruprasad Srinivasan, who is the CEO at Quess Corp, and Mr. Kamal Pal Hoda, the CFO at Quess Corp, are joining us on the show to talk to us about their earnings. Hi, gentlemen. Good morning, and wishing you guys a very happy Dhanteras. Mr. Srinivasan, wanted to begin by asking you, it was a mixed set that you guys have delivered this quarter. The bottom line was impacted by higher other expenses and higher taxes. Could you talk to us about whether there was a bit of a one-off here, or this is expected to continue going forward as well? And what about the growth outlook for the second half of the year? Is it going to be better than H1?
So sure. Thank you so much for having us, and wish you and your viewers happy Dhanteras in advance. It was a good quarter. Q2 was a good quarter, and by headcount, we have grown 11%. We have added about 42,000 headcount in H1 itself. And vis-a-vis last full year, we added about 56,000 by headcount, whereas in this H1, we have done about 42,000. So from that standpoint, we've just crossed about 6,09,000 by headcount, 11% growth. Our revenue growth has been 9% year on year, and EBITDA growth at 16%. Our PAT has grown 72%, H1 to H1. So overall, it's a good quarter, and there are no one-offs in this. So we are on plan in terms of our EBITDA delivery of 196 crores that we have delivered. There was one-off probably in earlier quarter where we did one of our divestment, and that is not recurring. We had sale proceeds coming in, and that is not in the current quarter, which is what is showing up in the result. But otherwise, we have delivered a PAT of 72% year on year.
So overall, happy with the kind of performance that you have delivered. But let me get Mr. Pai also into the conversation, Mr. Kamal Pal Hoda, that is. Just wanted to get a better sense from you that, of course, there has been the strong growth in the global capability centers, and that has been the latest buzzword that we have kind of heard a lot about. Is this kind of momentum expected to continue, and what kind of growth rates should we envisage coming in from this segment, especially for IT staffing?
Yeah, thanks for this question. So you are right. Global capability centers has been a focus area for us as well as in our IT staffing business. Now, this business has gradually become almost 65% of our total IT staffing that we do, and this continues to have a good momentum. However, the overall ITS staffing, that landscape has not moved considerably now for almost 7 to 8 quarters. We're just seeing some slight green shoots in the large IT companies' results. But otherwise, GCCs has been a focus area, has done really well for us as the IT staffing business, especially on the back of GCCs, has been performing more than 100% of our AOP plans. And we expect this momentum to continue in the upcoming quarters on the GCC side.
The GCC, overall staffing looks on the positive side. The company is going through a three-way merger process to unlock the shareholder value. Could you talk to us about the timeline of the process completion on that one, Mr. Srinivasan?
Yes. So we started this process in early Feb this year, and we are happy to share that we have got the first motion clearance from NCLT, and we have a scheduled shareholders meeting scheduled on the 9th of December. So we are on course in terms of the plan of three-way demerger, and from there, I think by Q1 next year we should be almost there in terms of completing the formalities and the process.
I was just going through your financials, and the revenue growth for most of your segments has been between 2 to 5% quarter on quarter, whether it's workforce management, global tech service, operating asset management, etc. What's the outlook for the second half of the year? Will the growth rate continue to be between this 2 to 5%, or there's expected to be a bit of an acceleration in the second half of the year? What's your take?
Sure. So, Q3 has been historically a better quarter for us in terms of revenue growth because of the festives. There is a lot of hiring that happens. And hence, what growth we have seen cumulatively in Q1 and Q2, we expect the H2 growth to be better than H1. On a full year basis, we should be able to demonstrate a double-digit growth, which we are confident of, both in terms of revenue and EBITDA. From the present quarter, which becomes, let's say, a base for next quarter, we believe that at least for next 2-3 consequential quarters, we should be able to grow 4 to 5%, both in terms of top line as well as EBITDA.
Double-digit growth for the entire 4 to 5% is what you are saying for the next few quarters. But what about the margin profile? Because the margin profile has come off a bit, if I have it right. It stands at around 3.8% in Q2. Earlier, this number used to be between 4.5% to 5.5%. Do you see it inching back to those margin levels, or this is something which is going to be sustainable for now?
Yeah, so we started this year at around 3.7%, and then this quarter we have clocked 3.8% margin. The guidance that we had given previously, and that's what we've been working internally as management, is to touch 4% this year, and we expect that quarter four we should be touching that 4% margin trajectory.
Okay, 4% margin trajectory is what you are aiming for. But Mr. Srinivasan, the gross debt level has also come off a bit. It's 253 crores, I think, at the end of this quarter. Almost 117 crore is what you have managed to reduce in the first half of the year. What's the plan going forward? Is this a big focus area for you?
So, of course, yes. And we have been consistently working on reduction of debt quarter after quarter. If you look at it, and it's been published in our results. And for Q3 and Q4, of course, we have a target to bring it down a bit more. So this year we said we will bring down our debt by 100 crores, and we have already done with that. But yeah, we have headroom to do a little more reduction in H2.
More headroom, and we'll watch out for what you actually deliver in the second half of the year. But the overall headcount has crossed 6 lakh in the quarter two. Which segments do you think are showing traction, and what's the target outlook for the next 2 quarters?
So, if I take by business platform, specifically in workforce, we see a lot of mandates, specifically the festivity around coming from e-com, logistics, manufacturing, and BFSI segment. And specifically, if I take GTS, again, both retail and BFSI segments are contributing to where the headcount are being added up from. Specifically in our OEM platform, the manufacturing segment is doing well, and we have been able to gain more traction in that space. Stepping into as an outlook for Q3, there are a few sectors where we are seeing little downplay for Q3. So specifically, BFSI would be a little bit slow that we are experiencing currently. IT services will continue to be slow in Q3. So that's second call out that we are witnessing from our open mandates. Where we are seeing demand coming in for Q3 is telecom and retail and some parts of BFSI from tier 2 and tier 3 segments. So Q3 is, I think, is little lesser mandates than what we anticipated, and it also moves on back of the Diwali dates. Post Diwali there will be little bit of downsizing that will happen in few specific industries, and the other set of retail and telecom should add back that particular downsizing that will happen from retail logistics. So largely, again, to summarize, BFSI, retail, and logistics supply e-com is what contributed to our growth to reach that 11,000 numbers net adds that we did in Q2.
Okay, so given the fact that you're talking about BFSI is going to be weak and IT is going to be weak, we are calling out that Q3 is going to be a bit of a weaker one. Is it fair to assume that the second half of the year is going to be weaker than first half then? So
for general staffing, it would be Q3 would be weak, but not for our GTS business, where we work on customer lifecycle management and the platform business. So that would Q3 and Q4 are stronger for us. For general staffing, it will be slightly weaker, but yeah, OEM and GTS platform should fill up that gap for us.
No, gentlemen, we let you go. Thanks so much.